Welcome back to Curious Commerce, Captive Budgeting Series, Part 19. In the previous video, we understood the meaning and importance of ARR. Now comes the most important part. How do we actually calculate ARR in exams and practical problems? Many students understand the theory, but when numerical questions come, confusion starts. The questions like which profit should we use? Should we use cash flow or accounting profit? Which investment value should we take? Why do some answers differ? In today's session, we are going to solve all these doubts step by step in a very simple way. This topic is extremely important for all commerce students and to attend competitive exams and interviews. By the end of this video, you will be able to calculate ARR confidently without confusions. Say, so stay till the end because we are going to learn the complete calculation process in the easiest curious commerce style. Jump into the calculations. Let us quickly recall one important concept. ARR is based on accounting profit. This is very important. ARR does not use cash flow directly. Instead, it uses profit after depreciation and tax. That means ARR follows accounting principles. Why is this important? Because many students accidentally use cash flow instead of profit. That becomes a common mistake in exams. So, from this point onwards, remember ARR always focuses on profit based method, and today we will learn formulas, steps, examples, tricks, common mistakes, everything in one complete session. Let us learn the main formula of ARR. The formula is ARR equals average profit divided by investment into 100. Very simple formula. Let us understand each part carefully. First, the average profit. This means average annual accounting profit earned by the project. The second important thing is the investment. Sometimes the question uses initial investment or average investment. So you must read the questions carefully and finally multiply by 100 to convert into percentage. Now, the another important point is which profit should we use? We use profit after depreciation and tax. Once again, I will repeat profit after depreciation and tax. This is because ARR is an accounting profitability method. It measures how profitable the project is according to the accounting records. The first step is calculate yearly profit, and remember profit must be after depreciation and tax. Let us understand Why? Depreciation is an accounting expense. Even though cash may not go out, accounting profit reduces. So, ARR considers depreciation. Similarly, tax also reduces actual accounting profit. That means we should not use sales revenue directly, cash inflow directly, earning before interest and tax depreciation directly. Instead, we use final accounting profit. In numerical problems, the question may directly provide yearly profit. Sometimes the question gives cash inflows, depreciation, tax rate. Then you have to calculate accounting profit manually. So, in step 1 is extremely important. Without correct profit, final ARR answer becomes wrong. So step 2, calculate average profit. The formula is average profit equals total profit divided by number of years. Very simple. Suppose profit for 5 years are 10,000, 20,000, 30,000, 15,000, 25,000. Add all profit, that becomes total profit. Then divided by number of years. That gives average profit. One important exam tip: do not use only 1 year profit. Use all years profit unless question specifically says otherwise. Average profit gives a balanced profitability measure for the entire project life. That is why ARR is called average accounting rate of return. Let's move to investment. This is where many students become confused. In some questions, initial investment is used. In some questions, average investment is used. So you must carefully read the questions. If the question says calculate ARR using initial investment, then directly use initial cost. But if question says use average investment, then the formula changes. Average investment formula we should use. Average investment is average investment equals initial investment plus scrap value divided by 2. Suppose initial investment is 1 lakh, scrap value is 20,000. Then average investment is 1 lakh plus 20,000 divided by 2, that becomes 60,000. So always identify which investment method question expects. This single mistake can completely change the final ARR. Example: suppose investment of 1 lakh rupees, total profit for the year for 5 years is 1 lakh. Now calculate average profit. Average profit equals 1 lakh divided by 5 years. That gives 20,000 rupees. Very easy. Now we have both values, average profit and investment. So we can directly calculate ARR. This is the standard structure followed in most exam problems. Once you understand this logic, even difficult problems becomes easy. Now the final calculations. ARR equals 20,000 divided by 1 lakh into 100. That is 20%. So ARR equals to 20%. What does this mean? It means the project generates accounting return of 20% on investment. Now, suppose company's required rate of return is 15%. Since the ARR is 20%, the project can be accepted. But if the required rate of return is 25%, then the project may be rejected. So, ARR helps the management to compare profitability. Let me give you an important examination tip. Before solving ARR questions, always check which investment is used. It means initial investment or average investment. This changes answers completely. The second tip is read questions carefully. Sometimes students hurriedly and directly apply the formula, but finance numericals requires careful reading. Even small mistakes can reduce marks. So follow step by step method slowly and carefully. These common mistakes. Mistake number one, using cash flow instead of accounting profit. Remember, ARR uses accounting profits only. Second mistake, ignoring depreciation. Depreciation must be deducted from the cash flows. Third mistake, wrong average calculation. Students sometimes divide incorrectly or miss years. So avoid these mistakes. Use correct profit, correct investment, and apply correct formula carefully. Then the ARR become one of the easiest chapter in capital budgeting. Revise today's complete topic. We learned ARR formula, accounting profit concept, average profit calculation, investment selections, simple numerical example, common mistakes when we calculate ARR. Most importantly, ARR is simple if steps are followed properly. Finance numericals are not difficult. Practice in the real key. The more problem you solve, the more confidence you gain. Solve full ARR numerical problems step by step. That session will help you master exam oriented questions. So continue your learning journey with Curious Commerce. If this video helped you, like, share, and subscribe. And keep learning finance in the simplest way possible. If you need daily updates, follow Curious Commerce Financial Management Hub in WhatsApp channel. Thank you for watching. See you in the next video.